G'day and welcome to This Explainer. Today, we're going to unpack something that honestly gets overly complicated way too often. But at its core, it's actually just a bit of straightforward math. We're looking at the exact mechanics of borrowing and how it physically changes investment outcomes. Now, straight up, I want to be absolutely clear. We aren't here to sell you on borrowing or tell you it's some magical strategy you've got to follow. Not at all. We're simply going to put the numbers into perspective and look at the purely mechanical differences between investing with debt and investing without it. Let's get straight into it. Okay, so this brings us to a massive question right out of the gate. Does borrowing actually guarantee better investment results? It's a question that gets thrown around a lot, right? But the truth is, we really need to strip away all the hype and that fear of missing out and just look objectively at the variables. We are not taking sides today. We're looking purely at the mechanics of what happens when you introduce a loan into an investment scenario. It doesn't automatically mean an investment is better or worse. It just means the math operates on a completely different foundation. Section 1. Investing without debt. The baseline. To understand how borrowing shifts the numbers, we first need to look at a grounded reality where you only put your own money to work. Picture this. Imagine you have exactly $200,000 of your own personal capital saved up. This is your hard-earned cash, sitting there, ready to be invested. This 200 grand will be our constant today. We want to see exactly what happens to this specific block of money under a few different conditions. Let's walk through the math nice and slowly here. In step 1, you take that $200,000 in cash and invest it directly into an asset. Let's say in step 2, that asset performs well and grows by 7%. So what's the result? Well, in step 3, that generates $14,000 in returns. And this brilliantly illustrates a really important point. When you don't use debt, your growth happens entirely on your original base of capital. If you were to take that 200 grand out and put it into a completely different asset that also gets a 7% return, your economic result is exactly the same. Without borrowing, moving from one asset class to another doesn't magically create some sort of multiplier effect, simply because your growth is always tied to that exact same $200,000 base. Section 2. Adding borrowing to the mix, the what if. Now, let's introduce a loan to the mix, purely as a mechanical variable, just to see how it shifts our numbers. Think of it this way. You still have that exact same $200,000 of personal capital, but this time around, you add a $400,000 loan alongside it. Suddenly, without changing your out-of-pocket cash by a single cent, you have the ability to purchase an asset worth $600,000. Your initial contribution remains exactly the same, but the total size of the asset you now hold, it's 3 times larger. Now let's imagine both of these assets experience a 5% increase in value over a year. On the $200,000 property without borrowing, that 5% growth yields a $10,000 gain. But over on the $600,000 property, that exact same 5% growth yields a $30,000 gain. The percentage of growth? Identical. Your actual cash invested? Identical. The dollar figure is only higher because the total size of the asset is larger. Section 3, the base of exposure, the core concept. That striking difference in the math brings us to the absolute most crucial takeaway of this entire explainer. The base of exposure is simply the total value of the asset that your investment returns are calculated on, completely regardless of the initial personal capital you contributed. So that $30,000 gain we just looked at, it isn't because the $600,000 property is inherently a better or more superior investment. Not at all. It simply happens because your 200 grand of personal capital has been exposed to a much larger asset. Any gains or, and this is absolutely critical to remember, any losses are going to occur on that much larger $600,000 figure, regardless of the fact that your initial cash contribution was way smaller. So the really crucial point here is how this plays out over the long haul. Over time, participating in the growth of a larger asset value can produce distinctly different wealth outcomes. When you're using debt, every single percentage point of increase is being applied to that higher base. This difference in the base of exposure is the purely mechanical reason why an investment with borrowing can look so radically different mathematically compared to an investment without it. Section 4. Important borrowing considerations, the reality check. We absolutely cannot look at those bigger numbers and just assume borrowing is some sort of wealth-building shortcut. It absolutely is not, and the real world has serious counterweights. Let's get real about what those counterweights actually are. When you borrow, you take on financing costs right out of the gate just to set the loan up. Then you have ongoing interest expenses that constantly eat into those returns we just calculated. And finally, you have the strict legal and financial obligations associated with carrying debt. I mean, you've got to make those repayments regardless of whether the asset goes up or down in value. Any comprehensive analysis of an investment strategy has to fully account for these real-world financial burdens. You simply can't look at the base of exposure without also looking at the heavy cost of getting there. So the next time you hear someone talking up the so-called magic of borrowing, ask yourself, are they looking at the whole picture or just the base of exposure? This content is general and educational. It is not financial advice. Before making decisions about an SMSF or any investment, consider seeking professional advice appropriate to your personal circumstances.